Hi, this is Keith Davidson at Albertson and Davidson, and today I want to talk to you about trust accountings. How do you get one, and what should it look like once you do get a trust accounting? So the first issue, how do you get a trust accounting? Well, under Probate Code Section 17200, you have to make a written request to the trustee to get a trust accounting, and the trustee then has 60 days to get that accounting to you before you can take any action in court. You also should go back and look at your trust document. There's some trust documents that will actually waive a trust accounting. That doesn't mean you can't get a trust accounting. You can still get one, but it does alleviate the trustee's duty to account to you just automatically on their own accord. Some trusts do not alleviate that duty. So if the trust does not tell the trustee they don't have to account, then the trustee should be accounting at least once every year. In addition to an accounting, you're also entitled to information. So just because it's not time to account yet, you may still be entitled to information, such as a copy of the bank statements, just so you can verify how much is in the trust, or a copy of an appraisal report for real property. So any type of information is also fair game as a beneficiary. You can request that. If you don't get the accounting after you've requested it in writing after 60 days, then you can file a petition with the probate court and ask them to compel an accounting. So ask the court to order the trustee to account and to file that accounting with the court so it can be approved by the court. The next question is, what should the accounting look like? And just because a trustee gives you an accounting doesn't mean that they know what they're doing. And not every CPA out there really knows how to put together a good trust accounting. A trust accounting is a very unique thing. It's very different from a business accounting. And so a trust accounting usually starts off with a list of charges and credits. And basically what a trust accounting does is it shows all the assets that were there when the trustee took over. It should show a schedule of income, all the assets that came into the trust, a schedule of gain, all the assets that came into the trust when an asset was sold and a gain was realized. And then on the credit side, it should show all the bills that were paid. Those are disbursements. It should show any distributions to beneficiaries. It should show any losses on sales, so if something was sold and a loss was triggered. And it should show what assets are left at the end of the accounting period. So once you have all of that, you can see everything that went into the trust and everything that both went out of the trust and is still there in the trust. And that's a proper trust accounting. Each of those categories I just went through should have a separate schedule listing all the detail. So the disbursement schedule should show every expense and bill that was paid out of the trust. So the date it was paid, the amount, who it was paid to, and the purpose for paying it out. All of that detail should be part of a thorough trust accounting. If you get something that doesn't report that level of detail to you as a beneficiary, then you have not received a proper trust account.